Any support anywhere, Carter?
Rubbing his hands together,
You could just pick your levels. But let's first talk about the concept of a bear market. Now, headlines always focus on the 20%, and really no one knows where that came from. But let's use that. If the Russell 3000 is the broadest investment aggregate we have, covering essentially the entire investable universe, which is obviously the S&P 500 plus the next 2,500 stocks, these are the numbers. 2,467, 83% are already down 20. So is that a bear? Or how about down 25? 72% of the constituents are down 25. Or let's go a little further. How about 30? 60% of the constituents in the largest aggregate we have are already down 30. It's a bear market. You can call it what you want. We know what it is, and it's presumptively not over. Where can it go? It's anybody's guess, but let's look at some lines. So actually, same deck here for the S&P, and this is the point, right? 20%, 66%. More than half are down 25. So we have a few big marquee names that are holding it up. As if and as they succumb, we know what happens. So in terms of levels, here's the long-term chart. This is the financial crisis low, the 6th of March, 2009. This is the U.S. debt downgrade in 2011. Right here, the 2016 industrial earnings recession. Right here, the plunge low of December. And so were we simply to come down to trend, which is 2,500, that's another 7%. Perfectly reasonable. But the real question is, could we get to the December lows? Could we give back this entire ricochet of the past year? We know the S&P is not it, but the transports have already taken out the low. The bank index already taken out the low. The Russell 2000 and the energy. So let's look at each of those, and then let's quit. The S&P, were it to get down to its ricochet low of Christmas of 2018, would be another 15%. The Russell 2000, on the other hand, would be a mere 4. Just 4. That could happen tomorrow at 9:32. Could happen next week. But the point is that's a foregone conclusion. And then here's the real issue. Look at some of these other aggregates. What we have is the transports. The transports have already taken out their Christmas low. And the key here is they never could make a high, never confirming what the S&P was doing. And finally, take a look at the bank index. Never confirming the S&P's new high and has taken out the low. None of this is good. And sure, you can get bounces along the way, but bear market, got a lot of problems, and let the dust settle before getting really excited about buying.
Yeah, we'll see if the dust does settle. Come on over. So Karen, if you look at Carter's chart there, I think I did the math a little bit. We're looking at about maybe we could have another 7 to 9% down on the S&P 500 to hit that 2,500 super long. Nice elbow. If you're on the radio, they just bump elbows.
Practice.
Super
long-term support.
The trend line, right? Think about it. Those are pretty important reference points. The 09 low, the U.S. debt down in 2011, the 2016 low, and the 2018 low. Were we just to simply touch that, that's 7%. But from there, it's anybody's guess. The real issue is the market, which made a new high, was never confirmed by most global aggregates, by the banks, the transports, and it calls into question whether we do really test the December low.
So you had talked about the Russell as being only 4% off of that.
That unbelievable plunge low, at which point it was itself was down 30%.
So does that make it more attractive to you relative to the other ones? Or
no,
not on a relative basis? I won't hold you to an absolute.
Yes, that's one way to look at it. One could say since it's so much worse, therefore it has more bounce potential. But I think it's because it's got so many things that are playing. First of all, its weighting in financials, as you know, is almost double that of the S&P, and small regional banks with rates and so forth are in real trouble. My hunch is that it's just it's a preview of coming attractions for the bigger indices.
And coming attractions are not things we tend to like to sit through.
I like the coming attraction. Sounds like a coming attraction of a bad movie. The bottom line is you see more downside likely ahead.
I think that's the message that I would convey, but I think it's also this. Let's say it's not about the downside. Switch the subject. Let's say we never go lower. There's always downside in investing. We know that. This is not tiddlywinks. It's about the upside. The upside is capped. If you look at the statistics on how long it takes to recover from a 20% decline, the median takes about 2 years.
2 years.
That's right. That's a problem.
And this may be where you're getting to, but let's cut right also to literally the shape of these charts. Investors are become so inured to expect a V-shape recovery. And we talk about it in the context of economies, and is it going to be a V-shaped recovery from the coronavirus? Who knows? But the charts themselves, that's a big ask. And
especially since we had the V off of the December.
Well, that's the reason they expect it.
V, right? And usually you don't. Meaning it's tricky to pull off a V. They're rare. U's are common. You heal, you cure. Ricochets are impetuous, impulsive, and they're rare.
All right, Carter, good stuff there on those charts. I mean, really long term, that Russell chart was incredibly dramatic. Carter, thank you very much. Need you to time.